Right now, I bet there's a list sitting on your kitchen table or in your notes app with a few states you're considering for retirement and the tax situation written next to each one. This one taxes your withdrawals, that one doesn't, this one leaves Social Security alone. And man, there's a quiet little thrill when you find that state that takes nothing. It feels like you just found extra money you didn't know you had. You're doing the smart thing comparing them properly instead of just picking a place because the name sounds nice. Now here's the trap, and the good news is you're early enough to see it coming. That list is measuring one thing, and that one thing is about to feel like the whole decision, when it's really just the line that was easiest to look up. The state that looks cheapest on that list is not always the state that's actually cheapest to live in. If you decide based only on the column you can see, you can win the tax question and still end up tighter than you planned. Here's why that's so easy to do, and it has nothing to do with being careless. State tax is one of the only retirement numbers you can actually see clearly. It sits on a chart. It's a percentage. Every best states for retirees list has it. It feels solvable because it is solvable. You can research it, compare it, pick a winner, and watch that number go to zero. Compare that to what a hurricane deductible does to your homeowners insurance, or what it costs in flights and rental cars to see your grandkids 4 times a year instead of every weekend. Those numbers don't sit still long enough to rank. Nobody makes a 10 best states video about them. So when you're deciding where to spend the next 30 years, the tax question gets all your research energy, because it's the one number that holds still long enough to study. None of that makes you careless. It's just where your attention naturally goes when one number is easy to find and the rest aren't. The problem shows up in what the list leaves out. Picture a couple doing exactly what you're doing right now. 66 years old, $500,000 saved. They decide to move from a state that taxes retirement withdrawals to one with no income tax. On paper, it looks like a clear win. They'd save about $2,400 a year. But then real life shows up. Their new house has way higher insurance because of hurricanes or wildfires, depending on where they land. That's an extra $1,500 a year. Their doctors aren't in network anymore, so there's a pricier plan and the hassle of starting over with specialists who don't know their history yet. And now they're flying to see the grandkids 4 times a year instead of driving across town. That adds another couple thousand easily. They saved $2,400 on taxes, but they're now spending $4,000 more in other areas. They won the line item, but they lost the total. That's what makes this trap so sneaky. The extra costs do not show up together on one bill. The higher insurance premium comes from the insurance company. The travel costs show up in little chunks throughout the year. The new doctor stress doesn't come with a price tag at all. So the couple just starts feeling like money is tighter than they expected without ever connecting it back to the move. That's the real mechanism here. It isn't bad math, it's math you can't see. Here's where it actually costs them in retirement terms, because a bigger insurance bill and a few extra flights don't sound like a crisis on their own. That $500,000 still has to produce income for 20, 25, maybe 30 years. It doesn't know or care that the couple technically won on state tax. It only knows what has to come out of it every year to cover the actual life they're living in the actual place they chose. If total costs go up by about $1,600 a year, even after the tax win, that's $1,600 more coming out of the account every single year. And the money you pull out early doesn't just leave. It stops earning for you for the rest of your retirement. Small yearly gaps, stretched across 20 or 30 years, quietly turn into big ones. There's a second cost here too, harder to put a dollar figure on but just as real. When you move away from the people who used to help you for free, your retirement plan picks up a line item it never had before. The adult kid who used to swing by and fix the garage door, the neighbor who'd grab your mail without you asking, the casual, built-in help that comes from living near family for 30 years. When that disappears, you either pay someone to replace it or you go without. And going without has its own cost in stress and in how safe you actually feel. And here's the cost almost nobody prices in. A move is not easy to undo. If the new place never quite feels like home, or the distance from family gets heavier as you get older, fixing it means moving again in your late 70s. That's a completely different game. It costs more, it's more exhausting, and it happens right when you have the least energy to deal with it. A choice that felt flexible while you were sitting at the kitchen table can quietly become permanent. That's what a trap really is. Not a bad decision, just a normal one that gets hard to reverse right when you most need room to change your mind. None of that shows up on a tax chart. All of it shows up in how tight the money feels. So why does this particular trap catch people who are otherwise careful with money? This is where it gets personal, because the honest answer isn't that you're not paying attention. It's closer to the opposite. Here's what's really going on. A lot of us had to figure retirement out on our own. We watched the pensions our parents were promised basically disappear. Instead, we got a 401k, a login, and a good luck. Nobody was coming to save us, so we became the kind of people who research everything. We compare options. We don't just trust the first answer, and that instinct is exactly why you made that list. It's a good habit. It got you this far. But here's the flip side. The same habit that makes you dig deep on taxes can also make you stop digging once you find a clear winner. You solve the one number you can actually measure, and then you feel like the whole decision is solved. The trap was never that you research taxes. The trap is treating that one research number as proof you've covered the whole question. But keep the instinct. It's a good one. You already have the exact skill this needs. You know how to dig into a number until you actually understand it, and nobody has to teach you that. The only shift is pointing that same effort at the 4 or 5 costs that don't come with a tidy percentage sitting next to them. Same person, same discipline, just looking at the whole picture. So before you circle a winner on that list, here's a simple way to do it. This does not require 47 spreadsheet tabs and a weekend alone with a calculator. Start by being honest with yourself. The trap isn't any one state. The trap is stopping the analysis at the tax line because that was the easiest line to find. Then add up the whole stack, not just the part that's easy to measure, property tax or the lack of it. Insurance, what it actually costs to get health care where you'd be living, travel to stay near family, and any cost that comes from losing the help you currently get for free from people nearby. Put a real number next to every one of those, the same way you did with the tax comparison. You don't need perfection here, you just need real numbers. Once you've got those numbers, put them side by side. Take what you'd save on tax, then subtract everything that moves the other direction, and get one honest number instead of a scoreboard with only one line filled in. From there, ask what that net number means for how much you'd actually need to pull from your account each year, not just in year 1, but for the next 2 or 3 decades. If the real savings turns out smaller than you assumed, or negative, that's the number that should drive the decision, not the tax line by itself. And don't ignore the things that are hard to put a price on. Distance from family or starting over with new doctors, those don't show up as a monthly bill, but they show up every single day. Put a rough number on them too, even an imperfect one, instead of leaving them out because they're inconvenient to calculate. Then ask one more thing before you commit. How easily could you undo this if it doesn't work out? A choice you can walk back without much cost deserves less agonizing than one you can't. If this move would be hard and expensive to reverse, that's not a reason to avoid it, but it is a reason to run the full number now while you still have every option open instead of later when you don't. Last, decide honestly what you're actually solving for. Lowest tax bill, lowest total cost, or the place you actually want to spend the next 30 years. Those aren't always the same answer, and it's fine if the honest one isn't the cheapest one. None of this means moving is wrong or that tax-friendly states are some kind of trick. For plenty of households, even after counting insurance, healthcare, and travel, the tax-friendly state still comes out ahead, sometimes by a lot. This isn't an argument against the move. It's an argument against deciding on one line of the list before you've filled in the rest. The point was never that you'd make a mistake. The point is that the same research instinct that found you a real answer on taxes can find you a real answer on everything else. Run the full number before you decide, and you'll actually know what you're choosing. instead of hoping the first win was the whole story. The number in your retirement account was never only about which state taxes it the least. It's about what it actually costs to live the life you want, in the place you'd choose, once every real bill gets counted, not just the one that was easy to look up. So before you circle a winner on that list, ask yourself one extra question. Is this state actually cheaper, or did the cost just move somewhere you haven't looked yet? If this helped you see the part of the smart move that never shows up on the tax chart, subscribe to Benji Knows Money. We dig into the retirement math people usually forget to count, the quiet stuff that ends up deciding how long your money actually lasts.